Hello and welcome to a brand new episode of Mind Over Money, a show where we talk about how meditation, yoga, and behavioral science can help you become an efficient and a better trader, investor, as well as a better human being. Well, my name is Shatajan, and today we have with us a very special guest, Rahul Jain, who is President and Head Personal Wealth at Edelweiss Wealth Management. Well, today we'll be discussing topics on behavioral science and how it impacts our investment strategy as well as trading. Now, Rahul has over 14 years of professional experience in wealth management as well as equity capital markets. Well, Rahul, let's the first question, probably which I want to put it across to you is that to be a successful stock market investor, apart from knowing about the companies you pick for trading or for investment purpose, one more thing is very important, and that is behavioral science. Now, usually, most of the experts or most of the thing which is usually on the channels or on discussion papers which talk to buy. Now, can behavioral science is something which definitely is not talked about more, but is very relevant to stock picking. What is your take on that?
I completely agree. I think if you see, as you spoke about a lot of news channels, newspapers, journally speaks a lot about fundamentals, technical, wherever you think about stocks or trading in the markets. But I personally feel the behavioral science is a very equal part. In if you want to create wealth, if you want to generate better returns, critical things like your emotions, your biases, your beliefs, which play a very, very big role. There's a common saying, correct, where it says that buy when everyone is fearful and sell when everyone is greedy. But it's opposite mostly happens. If you look at yesterday also, when the Nifty was down significantly, correct? And now you know that there are certain fundamental stocks which are very good, which you wanted to buy. Now, when the real time has come to buy, you will still think, Array, whether we should I buy or not, whether your emotions are there, whether are you thinking practically. I think this is a very, very common feature. I have seen this very, very commonly that usually as an investor, you get into a good fundamental stock, understanding about everything, and you hold on to that stock. Now, when the market starts falling down, and obviously your stock is also related to markets, the fundamentals of the company have not actually changed, but the markets have gone down. And if markets go down, you also tend to exit your positions or able to exit the portfolio from those stocks. I think these type of biases, the way you think at that point of time emotionally, plays a very, very important role on finally making a very good judgment on your portfolio, when to exit, when to enter, and all that. And I think in that sense, behavioral science or the things related to behavioral science like emotions, your beliefs, your biases plays out a very, very critical and important part.
Right. In fact, that could be one difference. With the stocks that you have in the portfolio, could become multi-bagger or could also turn into wealth destroyers if you don't get out of those stocks quickly. Now, if we quickly come to the biases as well. So, what is confirmation bias, and do you think this actually overclouds your thinking or thinking of the trader or an investor or anybody who's just picking that stock?
So, to just answer what is confirmation bias, it is interpreting things in a manner that's consistent with your own views, and you try to take those views only which are very, very similar to what you have been thinking, and that is what is called confirmation bias. Generally, what I have seen, and when you see that a lot of stocks which are deeply holded by or majority holded by retail investors also, there's a lot of confirmation bias which keeps creeping in. Where you have a thinking that this stock will particularly do well, and you have your own biases, and then anything which comes negative about that particular stock, you either tend to ignore, or you are more paranoid of looking at only positive news about a particular stock, and that actually is not practical. It is not logical in terms of thinking. But you are biased and you keep holding on to a certain stock, and which keeps going down, and you keep averaging. That creates a whole problem, and that's why the confirmation bias really overclouds your thinking in that sense. Certain more confirmation bias examples. If you look at market corrections like yesterday, or market correction which happened during COVID, correct? You heard a lot of people, and you said, or everyone said that now market will really tank and it will go down more. And then there you built a confirmation bias that it's better to exit it out. If you would have been logical, patiently thought about it, I think you would have stayed back and you would have made great returns. But your confirmation bias uh, made you exit your portfolio at that wrong very time. You keep holding on stocks which are negative, and you keep selling off stocks which are good stocks and generally positive. But that is how the confirmation bias keeps happening every time, where you are very confused, or you have a biasness over a particular thing, which makes you not think logically about a particular thing, and that is again a big problem while you want to invest or trade, because market is a volatile environment, and if you are able to use your emotions well, you can make out a good return effectively. Again, there is a very common saying that when markets are going up, you become blind to risk, and when markets go down, you become blind to opportunities. And I think this is very common with the whole confirmation bias concept.
Definitely. Well said. And lastly, there's another bias that we'll quickly talk about. That is another behavioral trait, and that is loss aversion. You spent decades of experience in dealing with investor behavior. Any particular stories, which you would like to share with our viewers as well?
So I think loss aversion is is again a very common thing where so what happens in equities is that a long term investment, and it can be a volatile investment. Okay. Now your trait of loss aversion always thinks about loss first and the gains later on. So you become very circumspect in your thinking, and which does not allow you as an individual to invest into something risky for short term but very beneficial for long term.
Right.
And that can be very detrimental to wealth creation, because end of the day, putting all of your money in bank FDs cannot create wealth for you, because it cannot beat inflation as well. Correct. That's why equity is a good segment. But yes, it has to be long term. It cannot be short term. It cannot be trading every day out. That is how it should not happen. So this creates a lot of problem effectively. I have seen a lot of people come to me and tell me that we put all of our money in FDs because we find it that it's not risky. We have seen a lot of people losing money in equities. I think it is again a very loss aversion thinking which is propagating that thought in their mind, and which might not be particularly right, because if you look at long term, equities are one of the best performing asset classes, and it gives you a handsome return. But you have to go with the volatility, and I think that is one thing which keeps them from achieving their financial freedom. It also creates a lot of challenges in them, because what happens is, suppose hypothetically someone is also pushed into investing in equities, but investment in equities is not his cup of tea. But what happens, certainly if market falls, he will exit from the portfolio. So there's again a very common saying, very interesting, that people lose more money in waiting for market correction rather than real time corrections.
Right.
And that is again with the loss aversion strategy.
Thank you, Rahul, for your time today. And well, that's all for now. But do stay logged on to etmarkets.com for more on news, business, and economy. Thank you.